In 2019, a construction company in the Midwest closed out its best year ever. $50 million in revenue. A backlog of projects stretching 18 months out. Happy clients.
A growing crew.
By every visible metric, this was a business firing on all cylinders. 14 months later, it was gone. Doors locked. Equipment repossessed. Subcontractors left holding unpaid invoices, some for work completed months earlier. Here's the part that should bother you. Nothing went wrong in the way you'd expect. No scandal. No fraud. No single catastrophic project. The company kept winning bids, kept finishing jobs, kept collecting payment, and it still ran out of cash if your instinct is to ask, but how much profit were they actually making? Good. That's the right question. Most people never ask it. They see revenue, they see busy job sites, they see cranes in the sky, and they assume that activity equals health. It doesn't. Revenue tells you a company is working. It tells you almost nothing about whether that company is solvent. This is the trap that swallows contractors of every size, from the two-truck operation to the regional player with a 9-figure backlog. And it's a trap that stays completely invisible if you're only looking at the numbers everyone else looks at. Top-line revenue, project count, client list. So what actually killed this company? The answer isn't one thing. It's a handful of financial mechanics running quietly underneath every construction business. Mechanisms that determine whether growth makes a company stronger or slowly bleeds it dry. Mechanisms most owners understand only after they've already been burned by them. By the end of this video, you'll understand exactly what those mechanics are, how they work, and how to spot them in any contractor you hire, invest in, or compete against. But first, we need to kill a myth, because almost everyone gets the basic business model of construction wrong before we even get to the complicated parts. Ask most people how a construction company makes money, and you'll get some version of the same answer. They buy materials cheap, mark them up, charge for labor, and pocket the difference. Simple retail logic applied to job sites. Buy low, sell high, repeat. It feels intuitive. It's also almost entirely wrong. Here's the reality. General contractors typically operate on net profit margins of 2 to 6%. Not 20, not 15, often not even 10. A company can post $50 million in revenue and walk away with somewhere between $1 and $3 million in actual profit before you account for a single delay, dispute, or unexpected cost overrun. Compare that to industries people assume are less profitable, like software or consumer retail, which frequently see net margins 2 or 3 times higher, and the picture gets uncomfortable fast. So if markup isn't where the real money lives, where does it go? Some of it disappears into overhead most outsiders never think about. Equipment depreciation, insurance premiums that can run into 6 figures annually, bonding costs, and a permanent underlying layer of risk that has to be priced into every bid, whether that risk materializes or not. But overhead alone doesn't explain the gap. The deeper answer is this. Construction profit isn't primarily generated by markup on the base contract at all. It's generated, or destroyed, by how a company manages the timing of money, and by a small number of specific, often misunderstood levers layered on top of that base contract. This is the part almost nobody outside the industry understands. And it's the part that separates contractors who compound wealth over decades from contractors who are one bad quarter away from the company in our opening story. Think about it this way. 2 contractors can win the exact same bid on the exact same project for the exact same price, and one will walk away wealthier while the other quietly goes bankrupt. Same revenue, same margin on paper. Completely different outcome. Here's something most people never think about. In construction, timing isn't a detail. It's a profit center. Picture a $1 in $1,000 project with a typical draw schedule. The contractor collects payment in stages as work progresses, say $200,000 up front, then draws at 25%, 50%, 75%, and completion. Meanwhile, that same contractor doesn't pay subcontractors and suppliers the moment they submit invoices. Payment terms to subs are often net 30, sometimes net 45 or longer. Do you see the gap forming? The contractor collects that first $200, zeros in draw before subs have even finished the work it's meant to cover. By the time subcontractor invoices actually come due, the contractor has often already been paid for that portion of the job and is sitting on cash that technically belongs to future obligations, but isn't due out the door yet. That gap between money in and money out is called float, and a well-run contractor treats float almost like a line of credit that costs nothing, using it to cover payroll on a different job, fund mobilization costs for the next bid, or simply sit in an interest-bearing account for a few weeks. Multiply that across a dozen simultaneous projects, and float becomes a meaningful, ongoing source of working capital, sometimes the difference between a company that grows smoothly and one that's perpetually scrambling for cash. But float is a double-edged sword. It only works if the pipeline keeps moving. The moment new projects slow down, or a client delays a draw payment, the float that once felt like free money reveals what it actually was the whole time. A temporary loan from your own subcontractors. One that eventually comes due whether you're ready or not. And this is exactly where the next hidden mechanic comes in. Because even when a contractor manages float perfectly, there's another force quietly locking up cash for months, sometimes years, on projects that are already finished. Let's go back to that $1,000 project. There's a detail we skipped, and it's the one that quietly wrecks more contractors than almost anything else. Retainage. On most contracts, the client withholds a percentage of every single payment, typically 5 to 10%, until the entire project is complete and signed off. Not complete for the subcontractor, complete for the whole job. So if a subcontractor finishes their portion in month 2 of an 18-month project, that 10% doesn't show up until month 18. Sometimes later, if there's a punch list dispute or a slow final inspection. Now picture a mid-sized electrical subcontractor. They've billed $800,000 across 4 projects this year. On paper, they're profitable. Margins look healthy, the P&L looks clean. But $80,000 of that money is sitting in retainage, locked up across jobs that won't close out for months. Payroll is due Friday. Material suppliers want payment now. The bank doesn't accept it's profitable on paper as collateral. This is the trap. A company can be genuinely mathematically profitable and still fail to make payroll, because profit and cash are not the same thing. Retainage is profit you've earned but can't touch, sometimes for a year or more. Now rewind to our opening story. A $50 million company, full backlog, strong-looking numbers, and still gone in 14 months. This is a major piece of how that happens. When a company is growing fast, it's simultaneously starting new projects, which consume cash immediately for labor and materials, while its retainage from older projects stays locked up, unavailable to cover those new costs. Growth, ironically, can starve a construction company of cash, precisely because retainage grows right alongside revenue, always trailing a few steps behind, always out of reach exactly when it's needed most. So if float and retainage are working against a contractor by default, how does anyone actually get ahead? The answer lies in the parts of a contract most people overlook entirely: the changes. Here's a fact that surprises almost everyone. The original contract is often the least profitable part of a construction project. The real margin lives somewhere else entirely, in change orders. A change order happens whenever the scope shifts from what was originally agreed. The client wants an upgraded finish. An engineer discovers unexpected soil conditions. A design flaw surfaces mid-build. Whatever the cause, new work gets priced and added on top of the base contract. And here's the part that changes everything. Change orders routinely carry markups of 20 to 40% compared to the 2 to 6% margin on the base bid. Think about what that means strategically. A contractor can win a project by bidding aggressively low, thin enough that the base contract barely breaks even and still walk away highly profitable, as long as change orders materialize along the way. This is precisely why experienced owners get nervous about unusually cheap bids. Low isn't always generous. Sometimes it's a loss leader, with the real profit engineered in later. Picture 2 contractors bidding on the same job. Contractor A wins by underpricing the base contract to beat the competition, then makes up the difference and more through change orders once construction is underway. Contractor B prices honestly from the start, wins the job on relationship and reputation rather than rock-bottom price, and earns steady margin without needing scope changes to stay profitable. Both can end up profitable, but only one of them is exposed if change orders don't materialize. If the client is disciplined, the design is airtight, and nothing unexpected turns up. Contractor A's entire profit plan was a bet on things going wrong, which raises an uncomfortable question. If the low bidder is relying on change orders to make money, whose problem is it when those change orders get disputed, delayed, or denied? That answer depends entirely on something buried in the fine print. Who actually carries the risk when things go sideways? Every construction project has a built-in assumption. Something will go wrong. Weather delays, material shortages, a supplier that ships late. The real question isn't if, it's who pays for it when it happens. And the answer is rarely obvious from outside the industry. Construction runs on a cascading chain of contracts, and each link in that chain is designed quite deliberately to push risk downstream. The owner hires the general contractor and writes contract terms that shift certain risks onto them. The general contractor hires subcontractors and writes terms that shift risk further down. Those subs may hire sub-subs, pushing it even further. Layered on top of all of it, bonding companies and insurers, who absorb specific, narrowly defined slices of risk for a price. Here's a scenario to make this concrete. A severe winter storm delays a project by 3 weeks. Who eats that cost? It depends entirely on language most people never read. If the contract includes a no damages for delay clause, the contractor may be entitled to more time, but not more money, leaving them to absorb the extra overhead themselves. If liability is written to flow downstream, the general contractor may pass that same cost onto the subcontractor whose schedule caused the holdup, real or disputed. Meanwhile, a surety bond might guarantee the owner gets a finished project no matter what. But that guarantee doesn't cover everyone else's losses along the way. This is why two contractors can face the identical storm, the identical delay, and land in completely different financial positions. One negotiated contract language that protects their cash flow. The other signed whatever was handed to them and absorbed a hit that should have belonged to someone else. Risk in construction doesn't disappear. It just moves toward whoever had the least leverage, the least legal attention, or the least experience to push back. Which brings us to the real payoff of everything we've covered so far. What happens when you put float, retainage, change orders, and risk transfer side by side, and watch two companies with identical revenue head toward completely different outcomes? Let's put it all together and go back to the question that opened this video. How does a company do $50 million in revenue and still collapse in 14 months? Picture two contractors. Call them Company A and Company B. Both do $50 million in annual revenue. Both operate in the same market, bidding on similar projects. On the surface, identical businesses, Company A wins jobs by underpricing the base contract, banking on change orders to make up the margin. They accept no damages for delay clauses without pushback because they're focused on winning the bid, not protecting the fine print. They don't track retainage separately. It just sits there, folded into accounts receivable, easy to ignore until it's not. When they hit a growth spurt, they start 5 new projects at once, all consuming cash immediately, while retainage from last year's job stays locked up for months longer than expected. Company B prices honestly and doesn't rely on change orders to survive. They negotiate contract language that limits their exposure to delay costs. They track retainage like a separate bank account they're owed, factoring it explicitly into cash flow planning, sometimes even financing against it. When they scale up, they stagger new project starts so cash outflow never outpaces what's coming in, same revenue. Same market, same margin, roughly, on paper. But Company A is one slow season, one denied change order, or one bad storm away from a cash crisis it can't absorb. Company B has built-in slack precisely because it manages the mechanics most competitors ignore. 14 months after their best year ever, Company A is the one that shuts its doors. Undone not by a single disaster, but by the slow compounding weight of float mismanaged, retainage ignored, and risk quietly absorbed instead of negotiated away. Company B is still building. Same industry, same margins on paper. Completely different fate because they understood something Company A never did. In construction, revenue is a vanity metric and cash flow discipline is the entire game. So what do you actually do with all this? If you're hiring a contractor, stop asking how many projects have you completed and start asking about cash flow discipline. Ask how they handle retainage. Do they track it, plan around it, finance against it? Ask what percentage of their profit typically comes from change orders versus the base bid. A contractor who gets defensive about that question is telling you something important. If you're evaluating a construction company as an investment or acquisition target, revenue growth alone should never impress you. Look at the balance sheet for retainage receivable, how much cash is trapped there relative to total revenue. Look at how fast they're starting new projects relative to how fast old ones are closing out and releasing retainage. A company scaling revenue faster than it's collecting cash is a company quietly building a countdown clock. And if you're in the trades thinking about starting your own company, build these mechanics into your business from day one, not as an afterthought once you're already scaling. Negotiate contract language before you sign, not after a dispute forces you to learn it. Track retainage as real money you're owed, not a rounding error. Price your base contract to survive on its own, so change orders become upside, not a lifeline. In every case, the lesson is the same. The businesses that last in this industry aren't necessarily the ones that build the most. They're the ones that understand where the money actually is and defend it accordingly. Remember that company from the start of this video? $50 million in revenue, a backlog stretching a year and a half out, gone in 14 months. At the time, it looked like a mystery, a business doing everything right, undone for no clear reason. It isn't a mystery anymore. That company didn't fail because it couldn't win work. It failed because revenue was never the real scoreboard. The real scoreboard was float, quietly running out the moment growth outpaced it. Retainage, locked away for months on projects everyone assumed were done. Change orders that either showed up or didn't, propping up margins that were never built to stand on their own. And risk, pushed downstream by everyone with the leverage to push it until it landed on someone who couldn't absorb it. Construction isn't really a building business. It's a cash flow and risk management business that happens to wear a hard hat. The companies that thrive for decades aren't necessarily the best builders on the job site. They're the best managers of timing, exposure, and leverage in the fine print nobody else reads. So here's your action step. The next time you evaluate a contractor, as a client, an investor, or a competitor sizing up the market, don't ask how big their backlog is. Ask about their retainage exposure. Ask what percentage of their profit comes from change orders. Ask who eats the cost when something goes wrong, because in this industry, the companies that look the strongest on the surface are sometimes the closest to the edge. And the ones quietly protecting their cash flow, dollar by dollar, are the ones still standing when everyone else's cranes go silent.